Session 11 is pricing profitability and activity-based pricing. This is also the very last learning session for you, so congratulations. Now, the formula that we'll be using in this session, some of these formulas and some others too. The very first one is profit equals price minus variable cost into the quantity produced Q minus fixed cost. Profit, you can think that there's a variable cost to produce each unit, and the profit from that unit is the price which is paid for the unit minus variable cost, and then you multiply that by the quantity produced. However, you also have to account for fixed costs. So after that profit per unit into quantity produced, you still have to subtract fixed cost to get the actual profit. So this is basically a measure of profit per unit without taking into account fixed costs. And this is price, and this is also sometimes called, this would be called margin, contribution margin per unit. The price, when you do markup pricing, the price of your product is going to be target price plus the markup. In this chapter for pricing profitability and activity-based pricing, we start with an example where a firm has this demand schedule. A demand schedule is for different demands, what the prices the firm can obtain for its product. And you're also told that the variable cost per unit is $3. The question is, what is the profit maximizing price? So you have these three different prices, and so basically you have to find which price will give you the maximum profits. Now, what we would like to do is maximize the contribution margin, because the fixed costs don't change. So as long as you maximize contribution margin, then profit will be contribution margin minus fixed cost, and fixed cost is going to remain same. So we don't really need to know fixed cost because it's constant for all these three different prices. So let's see what is the price minus variable cost into quantity, which is also called contribution margin. And you subtract fixed cost from that quantity and you'll get profits, because you know that profits equal revenues minus fixed costs minus variable costs, and revenues are price into number sold, so price into demand is revenues, and from that you subtract variable cost, that's contribution margin, and you subtract fixed cost, you'll get profits. And fixed costs are constant, so you don't need to worry about fixed costs, because you're not being asked calculate what the profit is, maximum profit is. You're just being asked which of these three give you the maximum profit. So basically, as long as you maximize revenue minus variable cost, that's all you care about. Or revenue is price into demand minus variable cost is, here we have $3 into the quantity which is being sold demand. So that's basically what we want to maximize. Or that is equal to price minus 3 into demand. So this is what we're looking to maximize. So 7 minus 3 is 4. 4 into 200 is 800. So this is the contribution margin. 8 minus 3 is 5 into 180 is 900. 9 minus 3 is 6 into 140 is 840. So this tells you that this is the maximum contribution margin, or this is the price and demand at which profit is going to be maximum. So profit will actually, maximum profit will be 900 minus fixed costs. And as we don't know fixed costs, we don't really know what the quantity of this profit is, but we don't care, because all we were asked to do was to find out what the profit maximizing price was. So the profit maximizing price is $8. Here we have an example of a firm, and you're given the cost data for its existing production, and it receives a new order of 100K units, and the question asks, what is the profit from this new order? So this firm, it produces blank DVDs, and currently it produces 200,000 blank DVDs, for which the direct materials cost is 30,000, the direct labor is 60,000, variable overhead is 15,000, and fixed overhead is 20,000. So when it receives this order for 100,000 DVDs, the price which it is given for each is 95 cents. And the question is, what is the profit from this new order? And say that this firm has a capacity with the existing fixed costs, we know existing plant and machinery, existing factory space, existing administrative staff, etc. It has a capacity of 400,000. So when you add 100,000 to 200,000, you have 300,000. So it's still below capacity, which means that there won't be any new fixed cost if the firm was to take this order. So the question is, what is therefore then the profit from this new order? Well, to do it, we first start by looking at the per unit variable cost. That's the first thing we want to calculate. Now the per unit variable cost, so let's do the, will be, so variable cost per unit will equal so you get that from the existing product cost data that you have. So the existing cost data tells you to produce 200,000, it needs 30,000 in materials, 60,000 in labor, and variable overhead, you'll take that into account, but not the fixed overhead, because we are looking for the variable per unit cost. We are wanting to find out what the increase in cost will be, and this is a fixed overhead. This is not going to increase with the new order, so this one we can ignore. So this we are not going to take into account. And then continuing with our finding the variable cost per unit, we have 30 for material, 60 for labor, and 15 for variable overhead, and you divide that by the number of units being produced, and that's 200K. So this will be 30 plus 60 is 90 plus 15 is 105. So 105,000 divided by 200,000, or that is equal to 52.5 cents per unit. So if this is the cost per unit for the firm to produce one blank DVD, then for 100,000 DVDs, it is going to need, the cost is going to be this multiplied by 100,000, which is going to be 52,500, and the money it will be paid will be 95 cents into 100,000, so that will be 95,000. So the money it will receive minus its cost is going to be the new profit from this order, and that is going to be 42,500. Here we have a question about markup pricing. So we first find the cost, and then based on the markup we decide the price. And the markup is 30%. So we have this firm which makes chandeliers, and the variable cost per chandelier is $50, and it has 6,000 chandeliers which it produces. The fixed cost is 90,000, and the question is, what would be the price if there is a 30% markup over full cost? So let's first do the full cost. So full cost is going to be equal to the variable cost multiplied by the number of units, so that's 50 into 6K plus the fixed cost, which is 90K, and that equals 390,000. And per unit, you divide this, if you want full cost per unit, you divide this total by 6,000, and you get 65. So 390,000 by 6,000 is 65. And then for price with 30% markup, you will have 65 multiplied by 1 plus 30%, or 0.3. So 65 into 1.3. And that is going to be $84.5. So $84.50 will be the price with a 30% markup. Here we have a question using target costing methodology. And here we have this corporation wanting to produce a new product using it wants to price the new product using the target costing methodology. The price at which the firm sells the product is $5,000 per unit, and there is a profit of 30% of selling price included. The question asks, what is the target price per unit? Now, if there is a 30% profit in this price, and that's 30% of the price, so the profit would be 30% into 5,000, which is equal to 1.5K. So this is the profit. 1,500 is the profit, and then the target price plus this profit equals the selling price. So target price will be equal to selling price minus the profit, or that will be 3,500. Here we have a question where a firm is trying to figure out if an existing customer account is really profitable, or whether it's unprofitable and they should like renegotiate with the customer or say bye-bye. So it's trying to figure that out. And what we have here is TX Corporation has estimated these costs. Now these costs are for order processing per order. It is $30. Now when the customer calls, the customer service cost per call is $10. Relationship management per customer per year is $2,000. So, relationship management, you may need an account manager or, got to pay salary, etc. The cost of goods sold per order is $80. Now, so these are the general costs, and now we come to a specific client, which is GS Corporation. And GS Corporation's order details for the last year are as follows. The number of orders it made was 50. The number of times it called customer service was 30. And sales were 10,000. So this is what GS paid to TX. And we have to now figure out if this account is producing a profit or not to TX. So to do that, what we do is we look at the revenues which this account produces, which is 10,000. And from that, we subtract the different costs. Well, what is the first cost that we have here? It is order processing cost, so that's $30 per order. And how many orders are there? There are 50 orders. So it'll be $30 into 50. So that's the first cost. What's the second cost that you need to subtract? Well, customer service calls are $10 per call. And this customer has made 30 calls. So it'll be $10 into 30. Next, we are going to have cost of goods sold, and that is $80 per order. And how many orders did this have? They had 50 orders. So it's going to be $80 into 50. And then the final cost, we have taken into account every cost except the relationship management per customer, and that's 2,000. So then you subtract 2,000. And so from 10,000 you subtract 1,500, 3,000, 4,000, and 2,000. Now from 10,000 you subtract 1,500, 300, 4,000, and 2,000, and you're left with 2,200. So that is the profit this particular account is producing. Of course, it could have been produced, if the revenues were lower or the costs were higher, it could have been a loss, in which case they should have renegotiated the account with the customer.